So construction mortgages explained, take the guesswork out, right? And agenda today is going to be construction mortgage scenarios that we're going to talk about, which what are different scenarios that you are going to need construction mortgage financing. What are different types of bills, right? Construction mortgage types. What is a construction mortgage? Benefits of a construction mortgage lenders, why banks may not, sorry, it has not been banned, but may not be ideal for construction financing, sorry for typo, and synopsis of construction mortgage, steps in construction mortgage process, and what are progressive draws, right? Understanding draw schedule, and percentage completion for a site built home upon which lender is going to pay the different draws, and how draw calculator works, and what are general details about construction mortgages. I am not going to do the numbers, and I believe and I hope that lenders are going to talk about their numbers, but if in case they don't talk about it, I will also talk about the general details and the numbers. How do you calculate like how much a client is approved and how it will be money will be given to the client, right? And then, like I mentioned, lenders are going to talk about it, but just in case if they don't, then I will cover that one too. Okay, guys. Now, construction mortgages are available for single homes, right? For subdivision and for commercial buildings as well. However, today we are going to talk about only for single homes, right? And our different other webinars, we are going to talk about subdivision and commercial buildings as well. But today, focus is going to be on single homes only, right? So what happens? Building a new home is an exciting chapter for new clients. However, getting approval for new construction mortgage is completely different story filled with different challenges, right? So typically, large banks view these construction mortgages as high risk. And why they see it high risk compared to the traditional mortgages? Because of the different unforeseen delays, including licensing and also Canadian weather as well. So what are different scenarios which are possible for construction mortgages? First of all, people normally buy a vacant lot or land for which they are going to require construction mortgage, or they can also buy it happens in old subdivision where people buy tear down properties and they need the construction loan to do the new home over there, right? And after that, some people don't tear down the property, but they need money for the renovation for existing property, which could be in a couple of hundred of thousands of dollars. That is also eligible for a construction loan, right? Now, in order to understand construction mortgages, we have to understand what are different types of bills and construction mortgages that typically lenders talk about, right? So first thing, that is self-bill. What is self-bill, right? When client acts as a general contractor and hires qualified licensed trade people to build the home, right? Client needs to prove that he or she has the expertise and cash resources necessary to carry the project from draw to draw. And the most important, to complete project on time. We are going to talk about it, why this is so important. That's why big banks see it as a high risk, because they cannot really sell an unfinished home. But in today's market, is completely different. But typically, that's what they see is a high risk market on that. So self-build is where client is going to act as a general contractor. They must prove to the lender they have expertise and cash resources necessary to carry the project from draw to draw, and the most important, to complete project on time. After safe build, typically speaking, majority of the time, people hire a general contractor. And what general contractor does for clients, that normally they coordinate the project with their contractor, suppliers, and trade people, which may be paid by the client directly or indirectly via the contractor. So if general contractor does everything, right, typically, then that's what they call general contractor. But if someone on their behalf and the landlord pays directly to the contractor, then general contractor will be, typically speaking, manager, project manager, and that capacity. That will not be a general contractor. And also, there is a term which is specific to Alberta specifically. They use this term often, residential home builder. Very, very similar to general contractor that we talked about, but where client hires home builder to complete the project from beginning to the end, and client pay in stages most of the time to the builder, not to the tradespeople. Right? Now, pre-built. When client simply says, you know what, it's way too much work for me to do the construction, right? And they decide to buy a pre-built home from a builder. So majority of the time when we are talking about going and booking our homes with builder, those are called pre-built. That is one of the type of the bill. And this is the normal new home purchase mortgage, not a construction draw mortgage that we need for this one, right? Very, very important to understand. So self-build, general contractor, residential home builder, and pre-built, that's where 90% of the people go, book a home with the builder, and then they simply occupy, they take the possession on the day of closing, right?
I have a question here. Is the pre-built and the pre-construction the same thing?
Uh, Pre-construction normally is the term used in condos. You know what I mean? And pre-built is used for homes where people go and book there, but that's what exactly pre-construction as well. Is that as clear?
Yeah, thank you. So, so like the new projects by Matami or any other builder, they are the pre-built as well. You could call them
Yes.
pre-built or the pre-construction. It's the same thing.
Yes, yes,
All
that
right,
is
thank you.
all those are pre-built, right? Now, what are construction mortgage types? Now, talking about different bills, now we are talking about construction mortgage types. So first construction mortgage is progressive draw construction mortgage, which we are going to discuss in detail, right, today. But one of the mortgage that's required for construction is the progressive draw construction mortgage. And also we talked about the pre-built, that's called completion construction mortgage. Also, when you take construction mortgage, at the end, when construction is finished, you get the occupancy permit, then that mortgage gets converted into completion construction mortgage. That's why we're also going to talk about why construction mortgages are beneficial as compared to taking the construction mortgage from the bank, right? Okay. So what is a construction mortgage? A construction mortgage, also known as progressive draw mortgage, is a loan where the borrower funds are used to help finance the construction of a home, right? The funds are released in installments, also known as draws, during the construction progress, right? The draw schedule is based on the percentage of the construction that has been completed. The station of the construction is determined by progress inspection completed, mostly the original appraiser. And we are going to talk about what are those different inspection and draws are and who pays for that as well. So no, as I talk about what are benefits of a construction mortgage, especially when we are talking about not alternative lenders, but mortgage investment corporation are those lenders who specialize into construction and not the big banks, right? Because, right, it's a short-term loan, it's advanced and multiple draws, it's low initial payments, and I am sure that lenders are going to touch about these payments and give you control and set rate of interest mortgage in advance, right? And these are all the benefits of a construction mortgage, especially when you're going to lenders who understand what construction mortgage is rather than as opposed to going to bigger banks. But we are also going to talk about why big banks may not be the best lender for that, right? So what are different construction mortgage lenders are? Schedule A lenders, guys, let me tell you one thing over here. During our last 21 years, since we are doing mortgage brokering, we have never ever completed a single construction mortgage with any A lender. Because of the red tape and because of the complexity, we have never ever closed any. But these days, Meridian is only one Schedule A lender who is doing construction mortgages, but we have never closed. Why? Because this is a short-term loan. It's much quicker with MIC and much control, much better ways, terms and conditions as compared to the Schedule A banks. So typically, majority of construction loans are completed with mix and private, but 90% with MIC and 10% with private, right? Now, we talked about why we really don't think that big banks are the best lenders for construction mortgage financing. May not be, because big banks often lack a specialization in construction financing for single homes. We are not talking about the bigger construction projects for a subdivision or other commercial projects, but I'm talking about especially for single homes. Banks are more stricter in terms of construction financing, and banks have a rigid draw schedule as compared to MICs, which are pretty flexible based on the needs of your client. And banks lock in uncompetitive rates. And let me tell you that, as we have never completed any mortgage with any A lender last 21 years, but I can tell you one thing, that they give you 5-year fixed rates, which are much higher as compared to the best rates available as of today. So best thing is that go to a MIC, a private lender who specializes into construction financing, because typically speaking, majority of construction loans which we have completed are typically between 9 months and 12 months. And after that, once that is completed, then go for the regular mortgage, and what we are going to talk about just right after this one. Right? So what's the synopsis of a construction mortgage? So first of all, apply for a construction mortgage, right? Then construction mortgage is secured with private lender or MIC or A lender is not the right one to do that, right? As we mentioned, so many different reasons why you don't want to go to an A lender. After that, construction commences. You complete the construction, right? Construction is complete. And that is the time when you are going to switch to a completion construction mortgage, because that is a regular mortgage. That is the best way to go for a construction financing. Right after that, what are different steps? I should rather say, typically, these are the steps in construction mortgage, but it could vary depending upon how ready you are and depending upon the lender as well. But typically speaking, first thing that you need to do is meeting with your clients, understanding their needs, and giving them the information about construction financing. Second step is based on clients' needs, right? Then you provide options. Okay, you can go to A lender, you can go to MIC, you can go to private. Now, this is our duty as a mortgage specialist, I should rather say experts in construction mortgage financing, to provide different options to them, because many times clients do not know what are their options available in construction financing, right? So next step really is submission with lenders, all the information, right? And I will also, we have already posted this information about, I think, a month and a half ago, but I will post it again, information for all those lenders who specialize in construction financing, and you can speak to them directly. We will have contact information for all of BDMs for all those lenders, right? So once you submit the information to the lender, typically speaking, a letter of interest, right, or a letter of intent from the lender is received, and that is then discussed. That is discussed with clients, and if client agree to proceed, then a good faith deposit with the lender is provided by the client at that time, right? Right after that, a commitment letter is issued, and we typically always advise, right, right after the appraisal, that clients must obtain a client ILA, which is independent legal advice, or ILR, which is independent legal representation, before signing final mortgage documents. That is the last chance, and the best practice should be that let client obtain ILA or ILR, let them understand it. And right after that, once everything is finalized, then after that, construction begins and funding starts as per agreement. Do you understand now the process, the typical steps which are in mortgage financing? So this is what it should be.
I have a question.
Yes, please.
What is the good faith fee that we talked about in the good faith portion?
Lender is looking for commitment from the client before they issue final commitment. And that's typical practice with most of the mortgage investment corporations. Right?
Is that any percentage that they have to put down? What is
It can be a percentage, it can be a flat like 2,000, 5,000, depending upon like whatever the situation, and depending upon different lenders. They may have 1%, they may have 0.5%, they may have 1/4%, or they can simply say, okay, give me $5,000 deposit before we provide you the final commitment letter.
So once they give you the final commitment, what happens next? Do they get back their 5,000 or 1,000, whatever it is, or is it kept as a security?
Yes, that is adjusted. That's adjusted in the phase.
Okay.
Moindapalji, I have a question.
Just a retainer.
Moindapalji,
It is a retainer. It is a retainer, basically. Good faith. That's what called the good faith deposit.
Moindapalji, I have a question is,
Yeah.
now in a construction mortgage, is it required that let's say if he's doing on a vacant land, that it should be free and clear, or they could have a mortgage on it? I mean, it could be they have equity of 20% or 50%, or it should be a free and clear land.
There's no such thing that land should be free and clear, right? As long as it comes into the complete picture and to the project, how much equity should be injected by the client, that's what matters the most. But typically speaking, lenders do want to have at least 25 to 50% of the land paid by the client itself before they can even start giving the funding for construction. But I think let's hold on to that thought when lenders are coming in, and we'll ask lenders, because different lenders have different requirements, but there's no such requirement that land should be free and clear, right? Typically speaking, if that is the case, lenders may require about 25 to 35% of equity injection into the land before even they can do anything else.
And typically, what would be the percentage of loan to value? The project is deemed complete, right? So on a completion appraisal, right? So what would be the typical loan to value a MIG is going to give?
We will reserve those one, but typically speaking, those questions should be for different lenders. But typically, different lenders have 65%, 70%, 70%, 75 and 80% to the actual building cost, or as built. It's depending from lender to lender. So some people do at the end value. Some lenders do at the construction cost, like how much the actual project cost is going to be. Just want to make sure. And it could be also up to 100% of the construction cost. Right?
Okay.
And that construction cost could be the appraisal value that would be, or would it be by the construction, the guy who's going to be constructing it, the builders?
That's the actual budget that is provided by client to lenders. That's the actual construction cost is going to be.
Okay.
Okay.
So it's like self-stated by the client that this is what I think it's going to be, or is it going to be a perfect figure by a lender?
It's provided by people like who are accredited into their profession. They are providing budget, and lender do review all the budget, and then they make their decision based on that.
So when, let's say, if the project is almost complete, so what percentage completion should the project be in order to switch to, let's say, a lender? Should it be 97% if that's correct?
I think you can order appraisal when it's 97% complete, but it should be 100% before you can get the completion. before you can get the completion mortgage. But
But-
yes, it should be typically 97% complete.
But for getting 100% completion, if I understand correctly, they hold a draw of 10%. Any of the lenders doing a construction mortgage till the time it is registered and all that. Is that correct? They will hold 10% of it and then finally
we are
release
going
it?
to talk about it. So we are just like stepping ahead of that. So we are going to talk about 10%. But yes, it is typically 97% when you can order the appraisal. Yes.
Okay.
And most of the lenders do accept 97% complete.
Okay.
Okay, so talking about progressive draws, a progressive draw means drawing and receiving funds at various intervals as house is being built, right? And a progressive draw mortgage means client builder draw the mortgage progressively throughout construction, right? Inspection and appraisal before each draw is completed, the cost of inspection and appraisal falls on borrower. So every time an inspection is completed and an appraisal is completed before they can do the draw. And now that's what you're asking, Gogi. A lien holdback up to 10% from each draw, right? The sum of money released to the client 60 days after occupancy permit.
Yeah. Okay.
So that must be considered at the time of budgeting and all this stuff. So that money is released, typically speaking, 60 days after the occupancy permit is released, right? Client must obtain all risk insurance and maintain the coverage throughout the construction period. You know what happens? There are some misfortune that happen where they are on fire and all this stuff. So you must obtain all risk insurance, right? Now, understanding draw schedule. So at what draw stage, how much the building needs to be completed, what is the construction state, and what's the percentage of total mortgage amount that is advanced, right? So first draw, which is typically speaking optional, right? And this is done when there's a 15% complete, building is complete. And what that made of is typically called a backfill draw when excavation is completed, foundation is done, and backfill is complete, right? It is typically for insured loans or when land is free or very little mortgage on land. And that's what for your question, Gogi, that it could be so many different scenarios that you talk about when there's a very little mortgage, when it's free, or it's an insured loan. And that's 15%. Now, that is typically speaking, this draw is most likely is going to be first draw for majority of the construction loans. And that is given when building is 40% complete, and including backfill, and then the lockup draw. It's typically called a lockup draw. The roof is on, the building is weather protected, right? Airtight, access is secure. And building that's typically on its own constitute about 25% of completion, this lockup draw. Second draw, but in this case, this is going to be third draw. It is done when the building is 65% complete. And this is called drywall draw when plumbing and wiring started, plaster drywall is complete, furnace is installed, exterior wall cladding is complete as well. And this draw itself is about 25% of the total mortgage when they advance for that construction loan. Fourth draw, when building is 85% complete, kitchen cupboard installed, bathroom completed, doors have been hung, etc. And in its own is 20% mortgage is advance of the total amount that is sanctioned for that project. This is the final draw, typically speaking fourth, but in this case, this is fifth draw, which is 100% complete. But you can order appraisal with Gogi. You asked the question, it's 97% complete, right? It's ready for occupancy with seasonal and exterior work completed, right? And itself is about 50% of the mortgage amount that is called draw is extended at that time. Now, what is percentage complete? I am going to post this presentation in our group. If you want to know about all of this stuff, excavation is 2%, foundation is 7%, subfloor is 4%. You can find what is the percentage of each and every stage. And I'll get down with my umbrella. Right? Guys, could you please make sure you're on mute? Okay. How draw calculator is going to work it out upon registration when 35% is draw, 65%, 100%, right? amount advanced, fee, sorry, oops, is the fee that is by the lender each time. 10% holdback is taken at that time, less accrued interest, advance, and then total. You can use this with your client to make him or her understand how draw is going to work in his or her case, right? Then general details that we're going to talk about construction mortgages are typically now up to 75% of appraised end value. And this was the question from many of you, that up to what percentage they do that. So up to 75% of the appraised end value, it varies and is dealt on a case by case basis, and it depends upon lender to lender as well. Draw can be advanced once 50% of construction process is reached, and this is known as backfill. If you remember that, this is the optional draw when there's no or very little mortgage on the land, or this is insured, then the 15%, this is the first draw called backfill, that can be advanced. Every time there is a 10% holdback on each draw, the lender, legal, and broker fees will be deducted from first draw. So many people do ask when the legal fee, broker fee, lender fee will be deducted. So this, all fees are deducted from the first draw, right? Starting from the second draw, each draw is subjected to an inspection fee plus a legal fee, which is paid by client all the time. The mortgage will be advanced based on the work in place. Interest will be charged on funds advanced. So many people think if they are going to take $500,000 construction loan that they will start paying interest on the whole amount. Guys, let your clients understand that your clients only pay interest on the funds which have been advanced and not the whole amount, right? So we don't have that much time, but very quickly, if client is taking $500,000, which is based on 5 draws, just to make it easier, and that is going to be, let us based on 12 months, then first draw, let us say that is coming after 1 month. So client is going to pay interest on the first $100,000 for rest of 11 months. Let us say the second draw is taken after 3 months, 2 months after the first draw is done. So client is going to pay interest on first $100,000 for 11 months and second interest on second $100,000 for 12 minus 3 months, just for 9 months only. So this is how interest is calculated. Interest can be paid monthly or deducted from each advance, and majority of the time it is also built into the loan, so client is never going to pay. So that is called interest reserve and the budget already before they start doing the draws, right? So it can be a first mortgage and second mortgage, typically short term, up to 12 months. Interest rates can be 6.99 to 8.5%, typically speaking, right? Based on the first mortgages. Interest paid on draws and not on total mortgage amount during construction. This is what we talked about, right? Construction mortgages, mortgage gets replaced by regular mortgage at the completion of the construction. This is basically what we advise our clients. This is the best way to do that. So they are going to have flexibility. They are going to have much better terms and conditions with the lenders who know what construction loan is. And after that, they can get the best mortgage based on their needs with the regular mortgage called completion mortgage, right? A construction mortgage may also cover cost of land, is how this has been designed to begin with, cost of material and resources, cost of hiring contractors, right? Construction mortgage may also be appropriate choice for extensive remodeling projects. And if you remember what are different scenarios we talked in the beginning, that it is also used for the extensive renovation for the homes as well. So this is what it is. It's extensive remodeling projects, because in the most cases, they provide owner with the more money, then it can be accessed from the home equity through a cash or refinance. So that is normally when you are using home equity line of credit or refinance, you can only go up to 80%. They do not consider the improved value, but when you're using construction loan, they use improved value of the property, right? So
I have a question. So in the last slide, you showed that even the cost of the land is covered.
Yes.
Construction. What? How does that happen? Like,
I will leave it up to the lenders here. Most of the time, they are going to cover how cost of land is covered, but this is how you do present all the construction loan to the lender. They will cover that. If it has not been bought yet, then they will also cover cost of land as well. There will be only one mortgage, first mortgage. If they have already bought the land, then there will be a second mortgage on the property, or the construction lender can take over the first mortgage and can give them the new first mortgage as well.
so just as you said before, it has to be, then they have to put up the loan to value ratio would be 50%, 60%, or it could be even higher.
It could be higher. It depends upon how they acquire the land and how a construction loan is going to be designed.
Okay.
It depends.
Okay.
It depends from lender to lender, right?
Okay. Thank you.
You're welcome. So I will give very generic information. Loan to value up to 75% of end value. Loan to cost up to 75%. So loan to value is what is appraised value. Loan to cost, what it costs to build that home, right? Position can be first or a second mortgage, advance on land. So you're asking this question over and over. So basically, there will be about 65% of the land value, right? If no building permit and site plan approved, up to 75% of land value if a building permit and site plan is approved, right? Pricing, typically speaking, for first mortgages, guys, 8 to 8.5%. And it's very, very important for you to understand, to make your clients understood it clearly, that first mortgages in construction are typically between 8 and 8.5%, plus 2% lender fee on an average. It could be higher, but again, on an average, 2% lender fee and 2% broker fee, which is deducted from the very first draw. So if client is coming to with the intention of they are going to take the mortgage at 2%, 3%, guys, make sure you do not, I should rather rephrase my words. So make sure you set up right expectations upfront rather than using the term that do not waste the time, which is true as well. But set up right expectations upfront with your client that the first mortgage for construction loan is going to be typically between 8 and 8.5%. You have to work out the numbers right in front of the client and how much it is going to cost them to build this home. This is how clients are going to understand it in a better way when you work out all the numbers. And second mortgages, typically speaking, are between 12% and 12.5%, and 3% lender fee and 3% broker fee. And again, fees, all fee will be deducted at the time of the first draw, right? And at that time, I will hold on to the present, like the lender presentation. We have, is Walter here? Hi, Walter. Is Walter here? From Mercury Mortgages?
Let me just unmute. Okay. Hello, can you hear me?
Yes. How are you, Walter?
Hello, everybody. Good. How are you doing?
Very good. I am glad that I never knew you were there, because I won't be able to speak in front of the experts. And I haven't done the right presentation, isn't it?
Oh, you're doing a great job. You're not leaving much for me.
Thank you very much. Thank you very much. I just want to make sure that I cover all the bases before you come in and start telling them what exactly it will be.
Yeah, no, that's great. Yeah, it's all good information so far. Yes.
Thank you. Okay, so you want to start your presentation, Walter?
Oh, I see. Okay, so I thought you still had something to add. Okay, hello everyone. Walter Koji from Mercury Mortgages. For those who don't know me or never met me, yeah, there's a few things that I just wanted to slightly modify to what Mohinder said, is because construction loans is a very special breed, and each lender who does construction loans does them a little bit differently. So the general guidelines that Mohinder just mentioned are great, but there's some modifications to it that need to be done. So first of all, when it comes to draw schedule, we in Mercury Mortgages, we don't really follow the certain percentage of completion. So it's not always going to be that, you know, the first draw is at 15 or 25 and the next draw is going to be at 40% or whatever that percentage is. We always discuss the draw schedule with the borrowers to see, what order of things they will do and when they want these draws. So some borrowers or some builders will want a different schedule of draws, and different builders will want a different schedule of draws. So we customize that to what they're planning to do. Having said that, the draw schedule will always be predetermined at the time before we close, and it's going to be specified in our commitment letter. So each draw will have an estimated date when they expect to be ready for it, and it will have all the items that they expect to complete at each stage. However, very rarely it happens that a construction project goes as planned. So during the construction period, there's a lot of times changes that need to be made, and that includes the order in which they complete certain things. They might plan, for example, that they will complete the exterior breaker stone in draw 2, and then something happens all of a sudden that they cannot do that. They have to continue the work on the inside, and then the work on the exterior has to be moved to the next draw, for example. So just because we schedule these draws a certain way in our commitment letter doesn't necessarily mean that we will have to follow it during the construction. So when that happens, the borrowers or the broker come to us and say, look, we need to shift certain items from draw 2 to draw 3, and then maybe move certain items from draw 3 to draw 2. And that's fine. We will always accommodate that, move things around, and of course, then the draw amount will also have to be changed, because each draw amount is based on the actual cost of the work in that particular stage. So if they have to move things around from draw to draw, we'll move them around for them, and we will adjust the draw amount. The same thing goes to the dates. The dates of each draw, yes, they might plan to be ready for each draw, every month or every 2 months. However, reality is different, and despite the fact that a date is specified in our commitment, if they get delayed for reasonable reasons, we're not going to be making problems out of it. I mean, of course, if the delay goes into 6 or 8 months, then we have probably some different serious problem. But reasonable delay in the construction schedule always happens, and we're always okay with it. So that's one thing. Income, we don't. Some lenders will require some kind of income verification or confirmation that the borrowers are able to, service or carry the debt. We don't do that. Just the same way as with our regular first or second mortgages, whether it's commercial or residential, we don't require any income verification whatsoever for construction loans. Doesn't matter to us. I mean, they may have no job at all, for all we care. Doesn't matter. One of the reasons why we don't really care that much whether they work or not is because during the construction period, we most of the time don't require any payments to be made. So like Monitor mentioned, the interest will simply accrue on the advanced funds. I'd like to mention that some lenders will accrue the interest on the entire loan amount from the very beginning. We don't do that. We accrue interest only on whatever has been advanced to date. Having said that, if we are dealing with a very large loan amount, let's say $1 million or $2 million or $3 million construction loan, obviously this will be a larger project or maybe a few homes. On large loans like this, we will require the interest to be either paid monthly, or we will deduct the interest from each subsequent draw, as opposed to waiting for that interest to be deducted from the final draw. But in most single-family home projects, the loans are not really, into multi-million-dollar amounts. That interest will just simply accrue during the construction period, and then we will deduct all that accrued interest from the final draw. This leads to one point that a lot of people will ask about, is if we are deducting all the accrued interest from the final draw, that leaves the risk of that final draw not being sufficient to cover the cost of the actual work. And the answer to that is that it usually does, because we do our total loan based on the final value of the project. Now, all the draws, except for the very final draw, are based on the actual cost. And when I say cost, that means land value plus the soft cost and hard costs. For those of you who are not familiar with the terms soft and hard, soft costs are all things like architect cost, permit cost, development charges, anything like this, basically, let's call it paperwork. Those are soft costs associated with the project. And the hard costs are the actual construction costs. So the amount of equity that the client has to inject in the project and the schedule of all draws is based on that total cost, as I call it, which means land value plus soft costs and hard costs. But the total amount is based on the value of the final value of the project. Now, typically, in most projects, the final value of the project is greater than the actual cost to build. So if we are basing our total loan amount on the final value of the project, then what that does is that the final draw is the amount that's designated for the final draw is actually much greater than the actual cost of work done at that stage. And that leaves the room for the accrued interest to be deducted, and it still leaves the draw sufficient to pay for the actual work. So that's one thing to bring up. Now, the construction holdbacks, as per the Ontario's Construction Act, lenders withhold 10% of each draw for that purpose. However, if our first draw is based on land only, then we don't hold back. There's no need to hold back the 10%. Because there has been no construction work done on the project yet. So as long as there's been no work done, there's no need for the holdback. But as soon as there is some construction done on the project, then there's going to be a construction holdback, and that holdback will be held back until 60 days after completion of the project. Or as a matter of fact, 60 days after they receive a occupation permit. So 60 days after that, this holdback can be released to the clients. Now, some people might think, well, if there was a cost in that particular draw, let's say we have a cost of $50,000, and you're going to hold back $5,000 for this construction, we are short to pay the contractor. But clients don't need to be afraid of that, because contractors know that there's something that's called a construction holdback. They expect it, and they will not ask for that money. They know that they will eventually get it after the project has been completed. So that usually is not an issue. Talking of construction holdbacks, sometimes what happens is that we get involved into the project in the middle of the construction. Let's say somebody started a project, they completed the framing and roof and drywall, whatever it may be, and all of a sudden, for some reason, the existing lender is not able to fund more, or maybe contractors put a construction lien on the property, and then they're kind of stuck for whatever reason, and then they come to us. If there is a construction lien on the property, and that's a very important thing for you to discuss anytime you see that there is a project in the middle of the construction or in the middle of any major renovations, you should always ask the borrower if there is a construction lien on title. You probably may want to make a note with a thick black Sharpie on whatever you're making your notes with, because it's a very important thing to know. The reason why it's important to know is because if there is a construction lien on the property, even if we are okay to do the deal and there is sufficient equity in the project that we can advance our funds and everything is fine, we cannot use our money to pay that construction lien out. In other words, we cannot advance the money directly to the construction lien holder to discharge the lien. So what would have to happen is we would have to come to an understanding that the lien holder would have to postpone their lien to our new mortgage, or they would have to trust the borrower sufficiently to discharge that lien, and then once we advance the funds, then the money goes to the borrower, and then the borrower has to pay that lien holder. That usually will not happen, but they might agree to postponing their construction lien to the mortgage. Once we advance the money to the borrower, and then the borrower can use the money to pay the construction lien if they choose to do that. If they choose not to do it, then that's going to be an issue between them and construction lien holder. But as long as that lien is postponed to us, we're not concerned about it. The reason why we cannot use our money to pay the lien holder directly is because we don't know if there might be another contractor who hasn't been paid yet, but hasn't registered a construction lien on the project. And if we use our money to pay the existing lien holder directly, and then we close our deal, then the next contractor decides, well, I'm not getting paid, I'm going to slap a lien on this project. If that happens, despite the fact that they registered that lien after us, they will still have priority over us. And that's a great risk for us as a lender. That's why we cannot advance our money directly to pay the lien holder. The lien has to be postponed first. And sometimes the contractor will not agree to it. Sometimes the contractor say, I'm not postponing anything. I want out of this project and I want to be paid. And if that's the case, we simply cannot do the deal at all. So it's very important for you to ask the borrowers if, or even have their lawyer check the title, or your lawyer. Purview will not show a construction lien, so that will not be a good information. The actual title has to be pulled, or simply rely on the borrower's information. But whenever you're getting involved in an existing project, always ask if there's been a construction lien registered, because that's going to be that may be potentially a serious problem. In terms of doing it, whether we can do it as a first or a second mortgage, sometimes doing a new first mortgage. Let's say the borrowers own the property. They may not have started the construction yet, but they bought some old home, or land only, whatever the case is, and they may have a mortgage on it. They may not want to break that mortgage to get a new construction loan, because there might be a big penalty for breaking that mortgage. So in that case, we can do it as a second. One thing you need to be aware of, and maybe even tell the borrower, is that if the existing lender finds out that the existing home, for example, has been demolished and they started a construction on it, most of the time what will happen is the existing lender will call back the loan. Basically, they will say, well, we want to be paid out right away, and if you don't pay out, we'll start legal enforcement. So it may be a little scary to the borrowers. However, it's not an issue for us whatsoever, because if that's the case, if the existing lender calls back the loan, then we basically pay them out. We would redo and restructure our mortgage. We would redo it as a new first. We would pay out the existing mortgage, and at that point, basically the interest rate, we will restructure the loan and change the interest rates from, let's say if we do it as a second at 12%, we will redo the loan, and we can do it the whole thing as at 8 or whatever the case be, right? So it's not really a big issue if the first mortgage finds out and they call back the loan. The borrowers shouldn't be scared of that, because we have the ability, funds are always there, so we have the ability to pay them out and get them out of the way. But like I said, we can start the project as a second mortgage. That's not a problem for us. The question that one of you guys had about the covering the cost of the land. So if we're dealing with a situation where a borrower is buying the land with the intention of building on it, we can do this kind of deal in two different ways. One way is if the borrower is simply buying the land and they don't have the drawings yet, they have no really good idea when they will be able to build, how long it's going to take them to get the drawings, get the site plan, building permit, all that stuff. In that case, we would just simply do a land deal to close the purchase, and basically, if they're planning to build and they're ready to build, let's say 6 or 8 months down the road, then we would do a separate deal, a construction loan, and then that could be done either as a second mortgage behind our own first, or we could redo the whole thing and do the whole thing as a new first. In case there are cases where somebody's buying the land and they already have the drawings, sometimes it happens even that the existing owner, the seller of the property, they might have started the process and they might have already got the site plan approved or get the building permit approved, and the buyer is pretty much just taking over the land that they might be ready to build right away. In that case, we could do the whole thing as a construction loan where the draw one would be against the land value only to close the purchase, and then the remaining draws would be done for the construction part of it. Regardless whether we're doing it the first way or the second way, the first draw on land will never be more than 75% of the land value. Sometimes it will be 65 or even 50%. That depends, where the land is located, what is the value of this land, do they have like I said, if they have already building permit on the land and site plan approved, we might be able to do 75% of land. Otherwise, if they don't have the permit yet, most often in a typical subdivision, it will be in the up to 65%. If we're doing with some rural property outside of the city, it's most likely will be 50%. So the borrowers will always have to come up with some kind of down payment to purchase the land. Having said that, if they do own another real estate, we could tag additional properties if there's sufficient equity in them, and that way we could increase our loan amount or draw on the land. So this way they might be able to buy it with zero down if we can use some other additional collateral. That's, I think, pretty much what I wanted to add to whatever was said already. I know Mohinder has in the presentation, some figures to give you an idea of how things work. Those are hypothetical figures there to give you an idea how things get calculated. But like I said, the calculation of the equity, the most important number is to calculate how much equity the borrower will have to inject into the project. If they have a very small mortgage or no mortgage at all on the land, most of the time it will be possible for us to finance the entire project from the start to finish without any kind of without the need of the borrowers to do any kind of work with their own cash. However, if they do have a mortgage on land, then the amount of work that they will have to do with their own cash will depend, how big that mortgage is. It may happen like, if they bought the property and got an 80% loan to value mortgage on the house, and they're demolishing this house now, then that 80% mortgage might be actually 100% of the value of the land itself. So in that case, they will have to inject quite a bit of work into the project before we're able to jump in with our draws. So these calculations, if you're feeling a little bit not sure or confused with all these different numbers, loan to value, loan to cost, and equity required, and exposure, and all this kind of stuff, whenever you have a construction project, I would suggest instead of going through all these calculations, unless you become very good and fluent with it, always give me a call, give me a situation. I will very quickly tell you what can be done. Whenever you have a construction deal, I simply need to know what is the land value, what's going to be the cost to build, and what is the existing mortgage on the property. Basically, based on these three things, I can tell you very quickly how much we can do, how much they will have to do, how much work they will have to do with their own money at the beginning, if at all, and this kind of stuff. So instead of trying to figure this out, on your own, you call me or even email me. You'll find usually that reaching me through email is, will give you a reply within minutes, literally. Calling me also works. However, a lot of the times I will not pick up the phone if I'm busy with somebody or I'm in a meeting, and then I don't check my messages until the end of the day. So if you call me, you might have to wait until the end of the day for me to call you back. If you send an email, usually I reply very fast, and then we can discuss it. Like I said, construction deals are a little bit more complicated thing. It's a very much on a case-by-case basis. So whenever you think you have a construction deal possibility, just give me a shout and I'll guide you through it, and we'll figure it out very quickly. So yeah,
Also, you want to run these numbers?
pardon?
You want to run these numbers, which I'm sharing right now, so they can get a very good, quickly idea of what you're talking about?
Right. Okay. So so we're dealing with a hypothetical numbers on the left side, right? Land value, soft costs, hard costs, end value, existing mortgage, and so on. So in this example, we are assuming that we're going to be doing a 75% of the end value of the property, and we're going to do 70% of the cost of the project. Now, this may vary. Sometimes, if we're doing a large project, multi-million-dollar home, $2-3 million home, we'll do 65. We might do 65% of the loan of the final value. We might do 65% of the cost. So it varies. But in this particular example, we're dealing with total. Now you're looking at the right-hand side. If you add all those items, the land value and the soft and the hard costs, that's what we use. That's what we call it as a total cost of the project. So $1.14 million. The exposure part of it is something that we use for the purpose of the calculation, how much work they will have to inject into the property. So even though the property, we have end value. End value is 1.3. So 1.3. Hold on a second. End value 1.3. Yeah. So even though the 75% of the end value will be 975, this will be the total loan that we can approve, $975,000. However, for the purpose of the calculation of the equity injection, or how much work they will have to do on the project, we use that exposure term, which basically will be based on the actual cost. So the actual cost is 1.14 million, and we're doing 70% exposure. That's 798, and take away the existing mortgage, 300,000. That leaves 498,000. So now, if their total cost, or their total hard cost was 600,000, and we take away this 498, that leaves $102,000. So that means they have to inject, or they have to complete $102,000 worth of work with their own cash. And once they complete that work, then we step in and we finance the project to completion and draws. And like I said, because we have this exposure of 798, but the total amount that can be approved is 975, it leaves quite a bit of difference there, and that difference will cover the accrued interest that will be deducted from the final draw. And that's, in a nutshell, that's how things get calculated. But like I said, every single construction deal that you will come across will be different, because there's going to be different loan to values involved. There's going to be different costs involved. There's going to be different loan to value on the final value, different loan to value on the actual cost. So this is very much just for illustration purposes, but it might give you a little bit of idea if you go through it and try to analyze how this works.
Thank you, Walter. There's a question.
Yeah.
What if a client have a house and land? There is a land that needs to be severance and built a house, but there's a mortgage on the property which exist. Sentran, you want to unmute yourself and clear the question, please?
Sorry, so the scenario is that they want to sever the property and there's an existing mortgage on it, and then what happens?
Yes.
Well, typically, well, if we're going to do a new first mortgage on it, then what would happen is that the mortgage, so if we do the mortgage before the severance, I assume this is the scenario, we'll do the mortgage before the severance.
Yes.
If we do the mortgage before the severance, then what happens is, let's say we do a $500,000 mortgage on the property, and they sever it. What will happen is then each lot after severance will show $500,000 mortgage on it. So if somebody will look from outside without knowing what has happened, they will think that each lot has $500,000 mortgage on it, and they may think that client owns $1 million, but it's not the case. So the mortgage will not get split automatically because of the severance. So once the severance is done, if we are continuing with the construction project, then we don't need to do anything. We know that client owes 500, and we don't need to do anything. But if for example, if the client will want to refinance the other lot, or maybe he will want to sell the other lot, then they will have to let us know that they have severed the property, and we will have to discharge that property. But now we will have to look at what has happened with our equity. Because if let's say if the property was worth $1 million, I'm just going to use a very simple numbers here. If the property was worth $1 million before the severance, and let's say we did $650,000 mortgage on it, because our maximum loan to value in that particular case would be 65%. Well, now they severed the land and they want to sell that land, then we will no longer have that other half of security. So we will not allow them to sell that unless they pay our mortgage down, so that we are left with 65% of the value of the other half that we're keeping. So they will have to contact us and let us know that they're severing the land, and they will let us know what they're planning to do. If they're planning to keep that second half and we're just continuing with the construction, then there's no issues, because we still have that other half as security. So we'll just continue with the project as usual, and the severance will really have no consequence. But if they're planning to sell that other half, then it's going to be a problem, because we will not allow them to sell. Because all of a sudden our $650,000 mortgage would be most likely more than 100% of the value of the half that we're left with. So definitely, they need to come to us and discuss what they're planning to do after the severance is complete.
Okay.
And they might actually, it might happen that after they sever the property, they might plan to build 2 homes.
Sure.
And which is fine. We'll finance both projects. That's not a problem.
There are a couple more questions, Walter. How long after final construction draw is funded, construction loan has to be paid off? Is there a time frame?
No, it doesn't have to be paid off at all. They may continue with us. Just what will happen is once they reach the full loan amount, the full approved loan amount, they will have to start making monthly payments if they don't pay us out, because at that point we'll convert it from a construction loan into a regular residential loan, and then they will have to start making regular monthly payments. So they don't have to pay us out. And then if it happens that the loan, we're doing, let's say, a loan for 6 months or 8 months, and they finish that construction after 8 months, it will have to be renewed. So we'll renew it. Sometimes they run so late that they don't finish the construction project before the maturity of the loan. Then we'll renew it as well. So that's not a problem. But once they reach the full loan amount, so let's say we approve a full loan amount of $1 million. We've advanced all the draws, and let's say all the draws and the accrued interest is $950,000. We will still allow that $50,000 to run into a monthly interest. So let's say if the monthly interest on the loan is $10,000, we might wait another 5 months before they have to start the monthly payments, because we'll have that extra $50,000 of interest reserve. But once the draws plus the accrued interest reach the full approved loan amount, then from that point, they will have to start making payments if they don't pay us out.
Okay. Okay. Okay, guys, any other question for Walter before we have Infinite Capital come on board? Any question for Walter?
There are.
Okay, could you please repeat those questions, Pawan?
Yeah, so there's one from Jaswinder. Can the borrower pay the property during the construction loan, assuming occupancy is guaranteed?
Sorry, can they pay what? Sorry, I missed that part.
Sorry.
Or can they occupy the property during the construction, assuming that the occupancy is granted?
Yes, sure. Once they get occupancy, they can occupy it. Doesn't matter. But I presume that by that point they will take
Yeah,
all
it
across from us.
it was kind of tied into my last question, so I got answers. Thanks. Yeah.
Okay.
There is another question. What are options of the borrower if the projects get delayed?
Well, like I mentioned at the beginning, they need to come to us, tell us what the situation is, why the delay is, and like I said, if we get delayed a month or 2 months, it's not going to be a problem. But if we see that there's a delay, that's something that's taking too long, and the resolution is not on the horizon, we might ask them to start making the monthly payments to cover the interest that's accrued.
Okay.
We're not going to call back the loan because of it, but we'll need to be careful how much interest is accruing. So we will probably ask them to start covering the monthly interest until the point when they resume the construction.
Another question: can the development charges also be part of loan?
Yes, development charges are basically part of the soft costs, right? So that's being taken into consideration in terms of the equity injection into the project.
Another question is construction loan fully open? Can it be repaid in full if someone is expecting to receive funds?
What we typically do is we make them open on 2 months notice. So if they give us 2 months written notice of a specific payout date, we'll allow them to pay it out without any penalty.
What is the time frame for approval, commitment, and actually start of the project?
Commitment is usually issued the same day when we have the appraisal. What takes the longest sometimes is the actual back and forth in terms of determining how the draws will look. But once we establish the draws, amounts, and dates, once we receive the appraisal, the commitment gets issued the same day.
Okay. What does Mercury guarantee the loan funds after they have made a commitment?
Sorry, can you repeat that?
How does Mercury guarantees the loan funds after they have made a commitment?
How do we guarantee the funds?
Yeah.
Well, we're issuing the commitment. That is our guarantee. If we don't fund from our fault, you can sue us. So no, it's never happened in 25 years. So the funds are there. Lack of funds has never been an issue.
Another question from Elizabeth. What area does Mercury lend out to?
So typically within an hour drive from Mississauga. So we'll go west to Kitchener, east to Oshawa. We'll go even as far as Bowmanville, up to Barrie, and then down to Niagara region, Crystal Beach, Port Colborne.
Okay, guys, any other question for Walter before we have Infinite Capital come on board? One last question for Walter. Seems no question. I am going to post Walter's information into the Facebook group along with the presentation. And also, I have a question that they want to understand numbers. So I will make sure that we can do the numbers one-on-one if you haven't understood the numbers. But like Walter said, when you have the information, let us know and we will work out numbers with you. But if you want to understand, I can do numbers one-on-one with you as well. Thank you very much, Walter.
Thank you very much, everybody.
Presentation, and look forward to working many construction loans with you. Thank you.
Sounds good. Same here. Thank you very much.
Thank you very much. Thank you very much.
Yeah. Bye-bye.
Bye-bye. Okay, guys. So we have Brian from Infinite Capital. Brian, you there?
Oh, Hinder, yes, I'm here.
Sorry, we got like half an hour late for your presentation.
That's okay. That's okay.
Okay.
Not to worry. I actually wanted to thank you guys for having me here. Basically, Mohinder did such a fantastic job explaining how construction mortgages work. And I actually created a little bit of a presentation for you guys. I just want to share it with you. And can you guys see my screen?
Yes, we can see that. Yeah.
Yep. Can you see it?
Yes.
So basically, there's a time you did such a great job of explaining from, meeting the client, how construction mortgages work. But a big part of the broker's job is to package the construction deal. And I thought it would be a great idea to talk to you guys about what necessary documentation you guys will need to package a construction deal, so that your deal gets funded, because at the end of the day, that's what we all want to do. So I'm just going to get into it here. So basically, every deal, what's different about construction as opposed to a regular deal is there's 3 components to the deal instead of just 2. Normally, it's just the borrower and the property. But in this case, we have a builder that gets involved. So when you're talking to your client, you want to keep certain questions in mind, to prove to the lender why this is a great deal here and why it should be funded. So when we're thinking about the borrower, we want to think, you got to ask yourself when you're talking to them, well, what makes this person a great candidate for a construction loan? Then when we're talking about the property, we want to go, well, is this project financially viable? How strong is their plan? And when we talk about when we're gathering information about the builder, you want to think, well, what level of assurance does the builder bring to the project? So when we're talking about documentation, there's about 4 things you want to gather from the borrower. First thing is mortgage app and credit bureau, which you do on every deal. But then there's the additional 2 things that you want to get from the borrower too, is a net worth statement from them and a bio of their experience in construction. Why this is important in construction deals, the net worth statement, why we ask for it, is because we want to see their liquidity. I have a example here of a net worth statement. As you can see, on the left side, it's all their assets. On the right side, it's all their liabilities. And basically what we want to do is, or what we want to check out is how much money they have in their bank accounts, GICs, their properties that they own, what mortgages they have on it, if they own a business, their car loans.
Brandon,
Yep.
can I stop you here?
Yep.
You are in a different projection mode here because we are seeing your upcoming slide as well as the slide you're presenting.
Oh, okay. Oh, I have it on the other
So
screen.
if I know that this happens with this projection all the time. So there has to be some change because we can only see a very minimal portion and I can't even read anything.
Oh, that's okay. Hold on. Let me see if I can fix this
Thanks.
here. Does that work better?
Yes.
Okay, perfect.
That's
Okay.
great. Yep.
All right, awesome. So why we ask for a net worth statement is because, like I was saying before, we want to check out their liquidity. It's an important document that all construction deals will need. And we always like to have the borrower sign it. So before funding, we will always ask for this to check out to see if the borrower is a good candidate, right? We want to know what, do they have lots of assets that are liquidable in case the construction mortgage goes bad? Are they able to get themselves out of it? So yeah, that's why we ask for that. We want to see how good of what makes them a great candidate for a construction mortgage. And then also what we do ask for is a bio on the builder, or sorry, on the borrower. And this doesn't have to be very long. It can just say, in my previous example, or back here, I was talking about Jill Winston. She's a real estate agent, a house flipper. So when you're talking about the borrower, you might want to say in a professional summary, I'm a house flipper. I've done this. I've done construction mortgages maybe about 5 times now. It's good to tell the lender that you are a qualified person. You've done this before. It's important to show that I guess, that they're a good candidate. That's essentially what you want to show. So you can also talk about the previous projects that you've done, maybe ongoing projects that they have, or future plans that they have to do in construction. All of this is really important information to show the lender that you have a great candidate here. Now, when we're talking about the builder has certain documentation that we also like to gather from them too. We like to have a bio on the builder, same type of deal as the borrower. We like to know the addresses of the previous projects that they built. So if you can gather that information from the builder, that's fantastic. We like to know that this guy's done it before. It's sometimes the builder that the borrower hires might be his first time doing it. That's not an issue, but it also gives us a lot of comfort if we see that he's done it, 5 to 10 times in the past. And so it goes, oh, you can look on Google Maps. Here is, he's done this house, this house, this house, this house. So it gives great, it shows us gives us comfort to see that they've done the project, or this isn't their first time doing it.
Hi, Ted.
Hello?
Yeah, go ahead lang. Okay lang.
Oh, okay, I'll continue. We also like to know if the builder, if he's registered with Tarion, and also another document that you would like to get for the construction project would be a contract between the builder and the borrower.
Okay.
If they have one in place, it's always good to have that documentation.
Yeah, looking at the numbers, it's very
to the lender.
over leverage.
So what's great about builders is the information that you're looking for on them, they typically post on their website. So you would also want to ask when you're packaging the deal together, does the builder have a website? Because they like to show off to you, here are all the previous projects I've done. They'll tell you, they'll already have a bio on themselves on their website, right? For this example here, this guy says they've been in the business for 75 years. That's something we love to see. And also on their website too, they will promote the fact that they are a Tarion builder. So sometimes you don't even have to gather the information on the borrower. On their website, they'll tell you everything you want to know already, which is great. Then documentation that you want
to. Sorry, Brandon, can you unmute yourself? I have muted all of them. Just want to make sure there was a disturbance coming up.
Yep, can you hear me now?
Yes, please, go ahead.
Okay, no problem. So documentation that you want to gather on the property is if it's a purchase, purchase and sale, MLS. If they already own the property and plan to do construction on it in the future, we'd like to know their current financing that they have on it, an appraisal if you have one, or a purview. Those are great documents that we'd like to see. And then for the future value of the home after it's built, in the beginning, that it might take some time to do that. So we'll work off an estimated value, but in the end, we will always need an appraisal before funding. So those are documents that you would definitely like to gather up to package the construction deal before you send it into the lender. One second here. Okay, and in the beginning when I was talking about you want to gather information on the borrower, the builder, and the property, we also like to see their plan. What plans do they have in place? Where are they currently? What's their current position in this project? So we like to see building permits. Building permits will tell us that the city is okay with what they're proposing to build and that they're ready to start doing construction. We also like to check out architectural drawings if they have them. That way it shows that their plan is on track and that we're ready to go. And then the budget. The budget is probably one of the most important documents in a construction loan. And the way to create a budget is, what you want to do is you want to split up the soft costs and the hard costs. Now, the soft costs are expenses not directly related to construction costs. whereas the hard costs are expenses that are directly related to the physical construction of the building. The best way you can think of this is if you had your property and you picked it up and you turned it upside down and started shaking it, all the paperwork that they spent money on would fall out of the property. Those are what we would call soft costs. So your architectural drawings, the engineering, the development fees, the building permits, all those expenses that the borrower would have to pay, those would be soft costs, and everything physically built on the property is what we call hard costs. The reason why we need to separate the two is because in construction, most funds or most lenders do not cover soft costs. We only cover hard costs. So when you're looking to get a loan amount, we won't pay or we won't lend on the cost on the soft costs, essentially. So this is just a little summary. I know this seminar was intended to be a teaching seminar. So when you're packaging a construction deal, what you want to do is the information you want to gather is on the borrower. You need app credit bureau. You want to get a net worth statement on them to prove that they have good liquidity. You want to know their building experience. Have they done this in the past? You can do that with a bio. And we also want to know too, if at the end of it, do they plan on living in the house that they built, or do they plan on selling it? When it comes to the builder, we want to know their experience, the company. We want to know information on their company, bio. Typically, you can find that all on the website. So it's great to grab their website, as I mentioned before. And we also want to know if they're a Tarion builder. For the property, typically, you'll find all of this information on the appraisal, but we like to know the lot size, what the land value is worth, and if they purchase sale agreement, MLS, and if they already have it, when they purchased it, and how much they purchased the property for. The reason why we like to know that is we like to understand how much skin the borrower has in the game. So, and then also we like to, as discussed before, on the property, we like to know what position they're currently in. So drawings, permits, existing financing, those are all great pieces of information you're going to want to gather to package the construction deal before sending it in. And then on the construction, the budget is probably one of the most important documents you can gather. And then if they have a contract with the builder, and also we'd like to, and on the appraisal, it will tell us what we expect once the property is complete, what the value of that house will be. So,
we have about 5 minutes to cover.
I'm sorry, I can't hear you.
About 5 minutes that we need to wrap it up.
No problem. I'm about to wrap it up right now. So how we lend on construction is we go by these three ratios. We lend up to 65% on the land value. We lend up to 100% on the hard cost and 65% on the end value. So essentially, as long as the loan amount fits in each of these categories and it all comes together, then we have a deal. So that's why the documentation is so important, because if you gather the proper documentation, this step here is very simple.
Okay.
For us with rates, our first mortgages start at 7.5%. Our second start at 8.5%. And on vacant land, we start at 8.99%. Our loan amounts can get pretty high because we do lend on subdivisions and condominium complexes as well. So that's why you can see our loan amounts can be as high as $50 million. On our second mortgages, we typically don't do those on subdivisions or condominium complexes. So they're anywhere from 500 to 3 million. And on vacant land, will end up from $1 to $20 million. The fees for this, they're in that 2% range, typically 2 to 3%. So, and that's it. I don't know. Do you guys want to hear about our residential products as well? Do we have time?
No, not today,
All
probably.
right, no problem. So that's all I wanted to talk to you guys about today. If you guys have any questions, you can email me. I have my contact information down here as well as Nina's. And
You can,
I would look forward to doing some business with you guys.
Brandon, if you can email it to me, I will post in our group so everyone
Yep.
can see your information.
Okay.
There are two questions before we can let you go. First question is that, can you lend to a builder who is not Tarion registered?
I'm sorry. I gotta turn this up. Can you say that one more time?
Can you lend to a borrower who was using a builder who was not Tarion registered?
Yes, of course.
Okay. Second question is, if builder is new and first time building in Canada,
Yep.
would you lend to the borrower?
Yes, yes. It all depends on the strength. We'd like to see that they do have some experience, but it will never kill the deal if they don't. A lot of times we have people that work in the construction field but aren't necessarily a builder, and we lend to them. Or some people have zero experience at all, and we still like the deal. So.
Thank you very much, guys. Any other question for Brandon before we let him go?
Yeah, I have a question. So how about the net worth, as you explained that, do you
Yep.
need any kind of certificates like for the GIC or anything, or is it just self-stated in a sheet, Excel sheet?
Yeah, I actually have a template I can send you. It's just an Excel spreadsheet. We just like them to fill it out and have them sign it at the end.
All right, sounds good.
Yeah, no necessary documentation.
Thank you.
No problem.
So just piggybacking off of the previous question, if
Yep.
the builder is new building in Canada, would the interest rate be higher than somebody who's a registered builder?
Yes, so typically, if we like to, how we typically will give a rate on the deals by the strength of it. So if we have a very strong builder and a very strong borrower, we'll be able to give you the best rate possible. If one of the areas is a little bit weaker, then it will affect what rate we're able to provide. That's why the documentation is important. I thought it was a good idea today to talk to you guys about it.
Thank you.
Are there any geographical limitations?
Geographical implications, is that what you said?
Yeah, geographical limitations, like to a certain extent that you guys.
If you're talking about, do you mean like lending area?
Yeah.
With construction, a lot of it's on a case-by-case basis. There are certain areas that we like or we prefer as opposed compared to other places. If you're way up north, it might be a little bit harder to get your deal done as opposed to being in the city. But I wouldn't say anything's off limits. It's just a matter of what do we like the deal as a whole.
So there's nothing like, even if you have a borrower who wants to borrow money in BC or in Alberta, you're okay to do it?
No, we're Ontario only for construction.
Okay.
Yeah,
thank you.
Okay, guys, thank you very much, Brandon. And please do
thank you.
with your contact information and also your presentation so we can post it in our private Facebook group. Thank you very much.
Okay, thank you. Have a great day, guys.
Okay. Hello, Brian. Could you hear me? Hello, Brian.
I can hear you. Can you hear me?
Yes, we can hear you very well. Brian Moscovitz, I'm pronouncing your last name right? Moscovitz?
Fantastic.
Thank you very much. Thank you very much. So guys, we have Brian Moscovitz from Moscovitz Capital, and over to you, Brian.
Thank you. Now, let me ask you this question. Mohinder, can I have a little slide. So
Yes.
On how do we do this? Can I show you some slides? I guess.
Yes. Yes, please. You can share your screen.
Okay.
Share screen.
Yeah, I'm going to do that. Okay, good. Perfect. Let me
Thank
just.
you. Guys, I would like to see your face if you don't mind. You have better face than mine. So I see many people, Amit, Syed, Safdar, John. Guys, if you can turn on your cameras, that would be great. It's nice to see you. Thank you very much. So yes, Brian, I can see something. Oh, yes.
Okay, so here we go. Let's see if I can get this in screen mode. A little.
Awesome. Presentation. Great.
My technology skills are
Looks
below
better
average.
looks
But
better.
And so is my decision making.
One thing you have to do, you have to change the display settings.
Yes. You know what I'm gonna do? Yes. Hang on one sec. I got you. I know exactly what I need to do. I got to flip my screen around. Sorry guys, just bear with me here.
No problem. We will have
It's
to
okay. You're waiting.
We make you half an hour wait. Sorry.
Take your time.
Oh, I have PTSD. I can't wait that long. Quick, Brian, quick.
Quick.
There you go. Awesome.
Okay, cool. Okay, got it. Okay, well, hi guys. Thank you. You have a really nice group here.
Thank you.
You got the whole city with everybody's.
Everyone is over here at the Call Mortgages today.
Yeah, amazing. Good for you guys. Obviously, no wonder why the real estate world is on fire right now. You guys are working so hard.
There you go.
We've been in this business for some time. I've been managing this mortgage investment corporation we're in our 15th and a half year. We were doing syndicating mortgages for 5 years prior to that. And so we manage this. I'm just giving you my 10-second little spiel about who we are. Because there's we're a little group, I guess. We're kind of a niche player, and not a lot of people necessarily know about us, but for those who do know about us, they really like us. And so obviously our job is to expand reach and grow the business and talk to more brokerages and agents to get our story out, because we have a compelling story. And we're not new to the business. And so I guess that's comforting perhaps to lots of agents, where consistency and reliability of capital is so important in the marketplace. And so I'm sitting in Toronto, in Midtown Toronto, a Yonge and Eglinton, but really we have a story of a combination of Toronto's story, which is where really the base capital is. But from a fundraising perspective, from a deployment perspective, we have across Canada story, starting really in Atlantic Canada, St. John's, Newfoundland, Halifax, Nova Scotia, and we slowly moved into New Brunswick. I was a director of the St. John Home Builders Association for 5 years. So you have a Toronto guy going to smaller markets, places where the lenders where lenders didn't show up, or a little bit off market, or perhaps with a bias of a down market. But we saw some tremendous opportunity in Newfoundland and Nova Scotia and New Brunswick. And so for the first half of our history, we spent a lot of time in Atlantic Canada and have an office in Halifax. Then we slowly moved west. I mean, for those who have relationships across Canada, Mohinder, I don't know, I guess you probably do, your agents do have relationships across Canada and fund mortgages in different places. Half of our book would be here in Ontario, and the other half of our book would be across Canada. And we slowly have seen opportunities in British Columbia. We have an office in another smaller market called Kelowna, should anybody want to go and expand into the Okanagan. We like to be members of all kinds of home builders associations. And when I go to these home builder meetings, and we're members of lots of different associations across Canada, we actually don't see a lot of mortgage agents, brokerages who are members of these associations. And my recommendation would be that if you want to pick up construction deals, become a member of a home builders association and attend the meetings and participate in the committees, because that's where the good quality builders hang out. Okay. So I'll give you a little of my 10-second story to where we fit in the world of risk. Let's see if we got a little. So I don't know, we've been using this, this is your typical risk. Farther you go out on the risk axis, the higher the risk, the higher the cost of capital. I mean, this correlation has been around since the beginning of time. Risk, return. And so we know that the banks, guys, sorry if I'm saying things that people already know, then you just, I don't know, just I'm sure you're doing other things anyway, but I won't spend too much time. But basically not to, and I know you guys know a lot of these things, but maybe in the context of where we fit in the world. Again, the banks and the credit unions, the reason why their rates are low is because they take on low risk. That's the risk return relationship. And so I like to think that we fit in between the banks and credit unions and other private lenders. And I don't call ourselves a private lender necessarily. I mean, we are a private corporation, private capital, but we are not in the business as a hobbyist. This is our full-time profession, and we are consistent, just like the banks and the credit unions, in regard to supply of capital. We're consistent in regard to our decision-making and our requirements for information. So we're a professional alternative mortgage provider. We are the mortgagee. Moskowitz Capital Mortgage Fund is who is registered on title. It's not Mr. Smith or Mr. Goldberg or Mr. Singh or anybody. I mean, not that those syndication groups are not good. They are perfectly fine. There's some huge syndication groups, but there is some comfort that you're dealing with the decision makers when you're dealing with Moskowitz Capital, and we're keeping everything on our own balance sheet, and we administer all our own mortgages. We have real ownership. So we take on moderate risk and moderate cost of capital. I want to highlight some things in the industry that you know about already, that there is private lenders out there that take on a tremendous amount of risk and they charge a lot of money, and that is corresponding. You take on a lot of risk, you should get a high return, because not everything goes great when you take on a lot of risk. There's another group out there, the friends and family and high net worth individuals. I call that love money. Sometimes take on a lot of risk, but they charge very little interest rates. Their cost of capital is low. And that's often how small builders get started. There's family money that comes in. Parents give money to the son or daughter to start off a spec build. And that's fantastic. A lot of businesses, whether it's in construction or any other type of small business, that's how they get started. I am a beneficiary of that. I worked for the Bank of Nova Scotia at the starting of my career. I did my MBA, then worked at Bank of Nova Scotia, specifically Roynat, and I was extremely lucky. I typed out a little business plan on a one-pager saying, I understand commercial lending. I could do it for Bank of Nova Scotia. I want to do it for you. And I can tell you that my original investors, that friends and family who set me up, were taking on a tremendous amount of risk, because while I said I perhaps know what I was doing, this is a business of long-term. Like, you know, the guy who starts on day one is not as good as the guy who's on year 20 in the lending business, because there is this accumulation of experience. And so I was a beneficiary of, so for some of that friends and family capital that took on a lot of risk, but didn't charge me a whole lot of money. And then we've since expanded, and those early investors have done extremely well. And we've accumulated investors as we've gone along outside of friend or family. Okay, let's see if I can move this thing forward here. Come on, Brian. Why isn't my thing going forward here? Hang on. Oh boy, I don't know why that's stuck in there. Who cares about that? Okay, let me show you some real deals. Actually, before I do that, let me give you a bit of context of where we fit in the world of construction lending. So we're between $250,000 and $10 million. Our loans are 6 to 36 months. Our rates are between 7 and 12. Really, most of our stuff today is sub 10%. Lender fees between 2 and 4. Sometimes if we really love a deal, we do a deal at 1%. Plus your brokerage, and we recognize you as your brokerage, and we put you on our commitment and our term sheets, and we deduct your brokerage fee and remit it to the brokerage on closing. We do like personal guarantees. Most of our stuff is in first position mortgages. We do the odd second mortgage. And we do believe, because we sit on cash, we issue term sheets in 24, 48 hours based on good information. We like something, we will get back to you if you send us good information. We get inundated with deals. Every single day we're getting multiple deals. The agents and brokers who send in information or call us. We love a phone call, guys. That is one of the secrets for us in success. If you send your stuff in and you call me and we talk about it, because I'm not, I'll go down a little bit later in regard to our preferences on deals, but we love talking to the agent and you telling us a little bit about your client as to what the story is. It's just so much more efficient. Maybe I'm a little bit old school that way. Okay, let's just look at some real deals that we have financed. And it doesn't, we're in Edmonton, we have different locations here, but it honestly doesn't matter. This house could be anywhere in Canada. There are some design preferences, by the way, you'll see along the way in regard to locations. But here's just a spec house, new home builder to construct. They're constructing multiple homes, and most of our borrowers deal with the banks. They have some kind of miniature construction facility, TD Bank, Royal Bank, and that they do the spec deals with us. We also love pre-sales as well, but if you have an established builder, you see, if you are on a marketing perspective, okay, here's my 10-second secret into how we find deals, by the way. We drive around into subdivisions in the core of the city, and we look for signs of construction. Somebody powering a foundation, tearing down a house, or particularly a construction sign. You know, builders love to advertise what they're building, and we take a picture of that sign, or we park in front of the house and we call, "Hey, Bob the builder, how are you? I'm standing in front of your beautiful house under construction, blah, 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 blah." And you give them your pitch, mortgage agents. It's really a boots on the ground type of thing for us. And I know that the agents who are extremely successful at originating construction are very much boots on the ground and driving around. My team drives around and looks for signs of construction. So that's how we found this guy. This guy was the president of the Home Builders Association. We were just driving around. This is in Edmonton, and we saw a sign up and we called him. And next thing you know, we're doing multiple houses with them. And we love spec construction. I mean, whether it's 420,000 or it's 1,020,000, I think that it doesn't really matter. It's 420 in Edmonton, but it's 1,020,000 in Toronto. We're capable of doing that. So if I'm the agent, the other thing that I'm kind of looking for, now remember, we're 250 to 10 million, so we're a relatively small ticket. But the thing that I'm looking for is somebody that is kind of newish to the business, because we know that the banks wake up in the morning and the first thing they say is send us 3 years of financial statements. And then they're like, well, I've only built 2 houses. I mean, this is my second year of business. And the banker just declines them. So if I'm the agent, I'm looking for somebody that's kind of newish, under 5 years in the business. And then you have this ability, their ears are opened. They're maybe a little bit of bias here. They're maybe a little bit earlier in their career, and they don't have those established banking relationships. Okay, so that's my trick of the trade. Driving around and looking for newish builders. We love commercial construction as well. This happens to be in Edmonton. This is just some building that's being just completely torn apart inside and renovated. And so we provided, this is a $2.8 million first mortgage. And I can tell you that commercial renovation, major structural work, the prices for that type of capital is in the 9 and 10% interest rate range. By the way, you can interrupt me at any point in time and ask any questions you like. So in addition to commercial construction financing, the other scenario is that we know that the bankers don't love is owner-occupied real estate. This happens to be in and around Kelowna and British Columbia, but it doesn't matter. It could be anywhere, anywhere in the smaller market. So this happened to be a hardware store that went dark. And so we finance the acquisition of the land and building, and along with provide working capital to renovate the interior of the building. So this individual, our borrower, will switch to home hardware. And it required this additional thinking or creativity of like, here's a term loan, and on top of that term loan, we're going to give you a construction facility of $500,000 to refresh the building and then get you into the home hardware franchise. And it's been an extremely successful loan for us. broker driven. So we paid a broker on this $40,000. We wrote this guy a check, 2%, just to give you some context of the dollar amounts. We earned 2% lender fee and the brokerage earned a 2% lender fee. Okay. We've done multiple deals with this brokerage. Here's another tip for marketing. Okay, so forget about the location, but this building here, I don't know if you can see my, this building here is new construction. Okay, well, that looks completed building. There's no new construction. There is a wonderful opportunity to look for what is called, I call them condo inventory loans, new construction. Inside that building, you're driving by these buildings all the time. Now, maybe you want to look, well, I don't think the size of the building matters all that much, frankly, although we can't handle more than $10 million worth of mortgage, but whether it's a high rise or mid rise, when you're driving by a brand new building, I can tell you there's guaranteed unsold units. You can find these unsold units. You can go on MLS, you can call the realtor. Oh yeah, we have 10 unsold units. The building might be 100 units. Those remaining unsold units, there's nothing wrong with these unsold units. It's that the builder developer is holding on for their right price because that is their equity. That is their profit in the project. So from a brokerage perspective, from a business origination perspective, if you can get a hold of the builder developer, the owner of that building, say, by the way, would you like a condo inventory loan up to 75% of the value? You might hear them starting to listen to what you have to say, because at the end of the project, you have a construction facility. It might be the Royal Bank, TD Bank. It might be some huge facility of $50 million. They get paid down, discharge. The loan comes down 50 million, 40 million, and there's a remaining of, pick a number, $3 million outstanding, secured against $10 million of unsold inventory. The term of the loan is up because generally construction, and always, not always, generally, I don't know, 90% of all construction projects, this is my number, gets somewhat delayed. And so the end of the term of the loan comes up on the bank, and the bank starts to, you know what they do? Hey, Bob the builder, the term of the loan's up. We'll give you another 6 month extension. But after that, you got to pay us back. So what can the builder developer do? They can either discount the units or move them out quickly, but that is their profit. So we have been very successful at providing condo inventory loans, and this is an agent's thing, a mortgage agent effort. When you're driving around, if you want to target this space is in the hundreds of millions of dollars, because we have done tens of millions of dollars of this business, where we put a first mortgage on the unsold inventory with partial discharges, and the owner, the building developer owner, is very excited. They write a little check to the bank, thank you very much, and then the bank says, okay, we're going to move on to your next project, because these builder developers have something else in the pipeline. Project A is finished, project B is starting, bank says finished, pay me off on project A, and I'll advance you money on project B. So this gets them to the project B start. And so just from a business development perspective, guys, I think this is a wonderful opportunity, easy to underwrite, completed units up to 75% loan to value. And there we will have to be competitive on pricing, 599, 699, 799 first mortgages. And these things can close relatively quickly, like in 3 weeks, 2 weeks. Okay. That's my tip of the day, condo inventory. You're driving around and there's this business is all over the place. And I just want to give you the banks really just don't love hanging on near the end of the project on a construction facility.
Brian, we have 5 minutes.
Guys, I'll be done in 4 minutes.
Awesome.
Okay. By the way, guys, let's just go right to the end here. We do like information. I know your last presenter presented things that you need. Let's assume that we need those things too. But I think one of the major differentiators with us, because I just don't like a lot of paperwork in regard to, like, I'm bombarded with, you can send me lots of paperwork and emails with attachments because eventually we need it. But guys, I do a one-page summary in your in an email, and you pick up the phone, you call Brian, Eugene, Melina, whatever team member you like, and call us and talk about your deal. and I can give you an immediate type of reaction. Yes, this is something we're interested in, and here's kind of the pricing. This is the things that you need and the things that we want to see. And guys, here's my other tip, because I worked in the bank. If you're waiting on an approval, it's not because anybody's working on your file. These bankers are not working on your file. They're just actually working on other people's files. So by giving them time, like when I was at the bank, I would get like this many applications, and then boy, I just put something aside and weeks would go by. It's not because they're thinking about your deal. They're not thinking about your deal whatsoever. And I would not wait for, I would push your lenders. See, I find the agents that are, oh, I have something in front of the bank, and they burn up a month waiting for a banker. You need to push your banker if that's the route that you want to go, because often we'll see the deals after there's so much pain and suffering at the bank. You push your banker to give you a real probability of success of getting this thing through to credit. And just by giving them time doesn't mean that they're thinking about your deal. You need to pressure them to say, guys, I got a client here. You got to tell me what the probability is. Otherwise, I got to call Monsters Capital, who wants to do this transaction.
You're awesome.
Guys, thank you so much. You email us. This, by the way, Molina's on my West Coast. You can call me. I'm here in Toronto. We know the real estate, the landscape really, really well. And we just love to entertain any of your deals. Call us, spend 10 minutes with me chatting.
Thank you.
Doesn't hurt.
I really appreciate. I think it was very nice the way you put up together the presentation. And guys, one thing I can tell you that every single word that Brian mentioned here about the banks, about the rates, about how to pick up a deal, how to look for a deal, I can attest every single word of his what he had said. So it is now up to you. If you have any questions for Brian, please feel free to ask any and all questions. We have 2 more minutes to ask questions. Guys, one question, can we submit application through Filogics to you, Brian?
Yes.
Okay.
I think I'm on Velocity. I don't get a lot of stuff through that, but yes.
Okay.
Sure.
Okay. Any other questions, guys?
There's so much business out there. It's completely up to you. Like it's like kind of extraordinary, guys, how much business is out there for those who want to work at it, to figure out a system, to figure out a niche. And we're in a marketplace that is enormous. And so honestly, the sky's the limit. You know who makes the most money in the world? The brokers.
Yes. And like you said, the right thing, there's a lot of business out there. You don't have to feel jealous of anyone else that someone else is doing. It's basically because you have to move your butt out and start getting the deals as well.
You got to move your butt.
Yep. Business out there. Right.
All right.
Okay, guys. Thank you very much. If you have
nice meeting you all.
Thank you very much, Brian.
Thanks, everybody.
Thank you, Brian.
Take care. Bye-bye.
Brian, could you send me your presentation?
Thank you, Brian.
Brian.
Yeah.
Could
I'll
you
PDF
send
it to
me
you.
the presentation so I can post it on our Facebook group?
Can I just call you back in like 5 minutes?
Yeah, we'll do.
Thank you very much. Okay,
Thanks,
guys.
Mahinder.
Take care. You have a great day. Bye-bye.